Welcome back to Federal Reserve in Focus. Fed Chairman Jay Powell making his first speech today since the central bank raised interest rates last week for the third time this year. Joining us right now is Hilton Capital Management Chief Strategist, bank analyst Dick Bove. Dick, good to see you. Thanks so much for joining us this morning.
Thank you,
Maria.
Maria.
A lot to cover with you as we begin the third quarter earnings reporting season. But first, what are you looking to hear from Jay Powell today?
Well, I think that what I would like to hear from Jay Powell is the fact that there's some 118 countries that have seen the value of their currencies go down this year because of the continuous increase in interest rates in the United States. And that's going to drive higher rates of inflation, higher cost of money in each one of those countries, and that's going to have a negative impact on their economies. It's making me start to think about the mid-1980s when all the countries in the world, so to speak, ganged up on the Federal Reserve and came to New York and created this thing called the Plaza Agreement. If the Federal Reserve continues to push rates higher and higher against the wishes of the president, against the wishes of this 118 countries, it would seem to me that there's going to be some negative feedback coming to the Fed. And I don't hear Jay Powell talking about this at all.
Hey, Dick, Lindsay Bell here. Looking at second quarter earnings, you're talking about interest rates, but net interest margins haven't been, they haven't really improved for the banks here. And going into the third quarter reporting period, the regionals have really suffered in the last month, almost down 6%. The large banks have done a little better, but still down 3%. That's versus up 7% for the market. What are you expecting out of second quarter or third quarter earnings?
Blah. Okay, in other words, I don't think the quarter is going to be particularly great, and I don't think it's going to be particularly bad. If you take a look at the segments that would drive earnings, you're not going to see any real problem on the loan side because, you know, we're seeing a significant increase in commercial industrial lending. We're seeing a very, very big increase in credit card lending, consumer lending, multifamily home lending. So the net effect is on the loan side, we're seeing the reasonable growth that we would like to see. But you're exactly correct. The banks have been competing with each other so vigorously that the asset yields, you know, if we take it from when the Fed started raising rates in the fourth quarter of 2015, for every 4 points that the Fed funds rate has gone up, the yield on assets has only gone up 1 point. And now the thing that bankers are worried about is that people are going to be clamoring for higher returns on their deposits. So I don't think that the net interest margin is going to be very much of a help. I think in certain other areas, you know, trading of fixed income product will not be good. Trading of equities will be good. So, you know, you've got pluses, you've got minuses, but in the end, you're not going to see very much, you know, if you will, forward progress from the banks in this quarter. And I don't think the stocks are going to take off for any particular reason.
Maybe you're getting tired of winning. 22% earnings growth is blah?
Well, I mean, you know, basically speaking, I don't think we're going to be looking at, you know, on a quarter-over-quarter basis, 22%. And, you know, where's the 22%
year over year, I guess,
coming
is the
from?
estimate. Year over year is 22%.
Yeah, but where's the 22% coming from? It's coming from the fact that taxes are lower. And it was a huge benefit to the banking industry. It's coming from the fact that loan losses are lower. It's not coming from the fact that the banks are out there selling something. In other words, you know, banks like, in other words,
I see what you're saying.
Banks are like everyone else. They got to sell something. They're not doing it.
What about trade? We just saw this new Canada deal, a new deal between the U.S., Mexico, and Canada. Any fallout from the trade deal on banks?
Well, it should be positive, right? In other words, you know, banks are domestic companies. There are only 6 banks in the United States that you might argue have to worry about what goes on in the international arena. You know, the vast majority of the 5,000 plus banks in the United States do everything domestically. They get their money domestically, they spend their money domestically, and if there is some positive impact in terms of more wage growth, if there's more positive impact in terms of manufacturing activity, they'll benefit. I don't see any negatives, you know, for the banking industry, other than, you know, Citigroup is the biggest trade finance company in the world, so they're not going to enjoy, you know, what's going on in the trade area. But, you know, for most of the banks in the United States, you know, all this trade talk is a non-event. All
right, Dick, we'll leave it there. Lindsay mentioned the earnings next week. J.P. Morgan is obviously first to report. Anything stand out? Any bank that you're expecting to stand out for the third quarter reporting season? Real quick, Dick.
Well, you know, I'm hoping that the banks that have a lot of investment banking activity, like Goldman Sachs, Morgan Stanley, J.P. Morgan, will surprise us there a little bit.
And of course, David Solomon begins this week, today, taking over for Lloyd Blankfein at Goldman as well. So we'll watch that. Dick, good to see you, sir. Thanks so much.